Guys and girls, welcome to your next lesson. This lesson, what we're going to be covering is the moving averages. Okay, so exponential moving average is the tool that we use when we're looking at analyzing the markets and looking specifically at the direction of the market and at places where the market can react from. Okay, so first of all, getting them onto your charts, most importantly, and making sure that your settings are correct. What we need to do is we just click on the indicator button we've got up here, and if we just type moving average, okay, or just type moving, you have the option of moving average exponential. Now there are a few different settings that we can use, and what we're going to show you today is the ones that we use on a regular basis. Okay, so if we just click this, okay, and what we want to do is we want to click it 4 times. Okay, 4 times. So once we've clicked it 4 times, we'll see a little drop down here on the left hand side, and these EMAs will all have opened up. Now what we need to do is adjust the settings of these EMAs. Okay, so for the daily time frame, okay, and take notes of this, the important moving average, okay, that you need to be using on the daily and the weekly time frames, even the 4 hourly as well, are the 8 and the 18 EMA. So if we just jump into the settings, we can change the length here to 8. Okay, and then if we just jump into the settings of this one here, we can change this to 18. So you can now see that we've got these on the charts. Now what I'm going to do is just hide the bottom 2 for now whilst we discuss these ones. Okay, you can obviously change the colors of these just so it fits in nicely so that you can see what you're actually looking at. Now there's a couple of ways that traders use the moving average. Okay, now what the first thing and the most important thing to understand is this isn't no magic indicator. It's specifically two average lines across a certain period. So we've put in the daily 8. Now what that means is it's a smoothed out line for the average move and the average price over the last 8 days. Okay, and then exactly the same with the 18. Again, 18 periods, so 18 days. Now a lot of traders will use this in a way whereby they wait for the crosses to occur, and when the crosses occur of those moving averages, it means that we can expect a potential change in direction. Now the problem with EMAs is that moving averages are what we call lagging, which means that, and I'll just show a perfect example we've got here. Okay, I use the vertical line tool just to demonstrate this. We can see the cross of the moving average right here on the 28th of August. Now once that cross occurs, the end of that day, we have already moved, okay, we have already moved from the highs 560 pips, which is a huge amount. So moving averages, they can help you. They can help in terms of looking at trend direction, but the crosses themselves are very lagging. They're very delayed, and therefore I wouldn't advise using this as a sole strategy to analyze and trade the markets. But of course, like everything we do and we teach here, you need to be using these things in conjunction with one another. Now on the daily time frame, what we like to use the moving averages for is to see when that change of direction has occurred, and then actually anticipate when the market can come back to that kind of average, which is the EMAs. Okay, so a classic example we've got here. I'm just going to delete this line. I'm also going to turn off the magnet. What you can see on this one here, okay, just draw the box around it, you can see that the market was in a bullish move. Okay, we've got a nice bullish movement up here. We've rejected these lows. We've bounced up here. Now we don't want to just be buying this market at the top of the candles or anywhere too high for that matter. We always want to wait for these retracements, and this is where things like Fibonacci comes in as well, which we talk about later. But as you can see, when we actually had that pullback, where did we pull back into and where did we wick into, okay, before we made that next high? And if I just zoom in, what you can see is that we pretty much rejected these EMAs to absolute perfection. Once on the 7th of August, once on the 11th of August. Okay, so they can be very useful and very important when you're looking at those bigger time frames, because number one, we automatically know the direction of the market is up, it's bullish, it's moving higher. And number two, if we want to buy this market, we want to wait for those retracements back into a valuable position, which, for example, in this scenario is pulling back into this moving average here. Okay, and this is a perfect opportunity to then start looking for areas to actually buy that market. Okay, and whether you have a stop below the other EMA or whether you look on a smaller time frame, you can catch some really good moves based on these moving averages. Okay, and even up here at the top, as you can see, we've spiked through a moving average. We spiked, we couldn't close, and then when we did finally close and closed below two of them, we then had that bearish move. So it really does help guide you in terms of what direction the market is moving. And if you are looking to get into that trend, okay, if you're looking to get into that trend, then you can look at those retracements into those moving averages. And then what you would do is you'd look on the smaller time frames to actually find yourself a good position to enter that market. So they're the moving averages we want to use on the daily, the 8 and the 18. Okay, we don't really focus on the crosses too much, but we do focus on what way the market is moving. Okay, as you can see, the two moving averages here, as they are kind of separating and moving away from one another, it means we're in a strong uptrend. Okay, when we then start kind of coming in a lot closer to each other, we are then in that downtrend. Okay, and as you can see, once we crossed that EMA there, we had that downtrend of 1, 2, 3, 4, 5 days. Okay, so a lovely 300-400 pips that you could have grabbed there. So I like to use these moving averages specifically when they cross, not when the moving average cross, but when the price crosses and closes below a moving average. Okay, that is usually a nice indication that we are changing direction. Or at least struggling at a certain point to go higher. And then we can start using the other factors that we've learned to choose a specific bias on this pair and find a very good entry. Now, the other moving averages we use, actually, before I just go into that, this is mainly, as I said before, mainly for the weekly and the daily. Okay, weekly and the daily time frame, even just the bigger time frames, basically, because again, you look on this weekly time frame here. Okay, once we finally closed below, we had a down week, a down week, a down week. We then had that kind of retracement up into the EMAs. We then had that EMA retest, and all of these wicks here as well just mean that there's a lot of sellers around these regions, these locations. Okay, and therefore, if we were looking for an entry to continue this trend, and actually look for more movement to the downside, then we know that the optimum area for that entry is around this EMA region. Okay, around the average, because the market's always going to come back to that kind of mean, that kind of average, like most things. So that's good on the weekly, it's good on the daily. Now, you can have it on your 4 hourlies. Okay, again, you can see that same kind of scenario happen. We've got that bearish movement here. We're pulling into EMA. We have a big move down, coming into here. Even these, if you're a very short-term trader, intraday trader, there's plenty of pips here, movement. Okay, you've got 50-60 pip movement there on that 4 hour candle. Even here, we pulled up into the second EMA. We've rejected it quite hard, and then boom, we've got a nice big downward movement of nearly 80 pips. Okay, so it's very useful, these EMAs, in conjunction with the rest of our analysis. But what we want to look at when we're on the smaller time frames is actually a different setting. Okay, so if we just tap this back on and we change that setting, we've got two important settings to use here. We've got number one, which is the 50 EMA. Okay, and again, I'm just going to change the color so it's a little bit more clear. We've got the 50 EMA. Okay, and we've also got the 100 EMA. So we're going to again just put these in. That one can be in orange, and we change this one to 100. Okay, so we have the 50 and the 100 on the lower time frames, and we have the 8 and the 18 on the higher time frames. Okay, so as we can see here, and I'm just going to hide the previous two just to show you the importance of these. Okay, when we are in a downward move, okay, on the 4 hour chart, where does the market retrace to? Okay, where does the market retrace to? So we pull back into the 50 and the 100, we reject, we show some bearish momentum with the candles. Okay, we've got a morning star candle pattern there, wick, doji, bearish, big bearish pressure to the downside. We then have that retracement. Where did we retrace to? We retrace back up, rejecting the 50 EMA. okay? And it will happen on the upside as well. It will happen on the upside as well. So we broke out of this level here, we pulled back into this region, and then what happens next? We pull back into the EMAs, and we bounce and have a big movement to the upside of about 180, 200 pips. So it's very useful to have the 50 and 100 EMAs on the lower time frames. Now, if we again just look into the hourly time frame, you'll see even more how important this can be. Pull back into this EMA region, rejection. And again, this is specifically, just trading with a trend, nothing else, just trading with a trend. So what we need to do really is we need to, similar to the Fibonacci video, which we go into a bit more detail later, we need to kind of just understand and be aware of where a market can pull back into so that we can enter a trade at a good valuable position. Okay, so that's your lesson on moving averages, and that's how we use them. As I mentioned before, don't put a lot of emphasis in the actual crosses of the moving averages. Obviously, it's great to see because you can then be aware that the market has already changed direction, and now your bias has changed, and therefore you're now going to be bearish. And a good example of this here is we're in a bullish move. We had that cross here, okay? We had that cross. I'm going to use the vertical lines again. We had the cross come in around this region here. We then pulled back to the EMAs, we went up. We pulled back to the EMAs, we went up. Okay, but then here, when we closed below, it's our first indication that potentially the market could change. We then had the cross again. Okay, our bias can potentially be bearish on this time frame. So what we're then going to be doing, we're going to be looking for retracements. Now this one went a little bit higher, but as I discussed, this one was a 4-hour 50 EMA. But again, we've just pulled up into these regions, come back down. Pull back into these regions. These ones are a little bit of a deeper retracement, and then we fall down again. Okay, so it's very useful having the moving averages on your chart. Just make sure the settings are correct, and moving forward it will help you to find those areas of value and find even more reasons to place the trade. The more reasons you have to place the trade using all of the techniques that we teach even in this beginner's course, the more probability that your trade direction is correct.